What happens when the guardian of the world's money presses the button too soon? Does it save the economy from the edge of collapse, or does it unleash the very storm it fears? Welcome to FluxFolio Finance channel. Today we dive into the Fed's September rate cut, the shockwaves it sent through bond markets, and the uneasy questions haunting every central banker from Beijing to Brussels. On September 17, 2025, the US Federal Reserve cut interest rates by 25 basis points, sliding the federal funds rate into a range of 4.0% to 4.25%. It was the first cut since December 2024, a decision both expected and feared. Why feared? Because inflation still stalks the economy, stubbornly above the Fed's 2% target. The textbook said, wait, don't move until the dragon is slain. But the Fed moved anyway. Why? Because the labor market is fraying. Job growth has slowed. Unemployment has inched higher. 2 consecutive months of corrected payroll data made investors whisper, is the system broken, or worse, rigged? The Fed's statement revealed the shift. Downside risks to employment have increased. In other words, jobs, not prices, are now the front line of policy. Here lies the uncomfortable question. Did the Fed cut because the data demanded it, or because Washington demanded it? Political pressure is never absent. Presidents and lawmakers crave cheaper credit, faster growth, and markets that won't implode before the next election. Dissent inside the Fed itself showed the tension. Stephen Moran voted for a sharper 5% cut, proof that even among policymakers, the balance is contested. But the Fed's own record points to the labor market, not politics, as the trigger. Still, in an era of polarized governance, the shadow of pressure lingers. Independence is a vow, but confidence is a fragile thing. Here's where theory met reality and broke apart. Tradition says cut rates, yields fall, bonds rally. But this time, long-term Treasury yields rose. The 10-year yield climbed above 4.07%. The 30-year jumped to nearly 4.75%. Mortgage rates followed higher. The yield curve steepened. Why? Because markets smell danger. Inflation risk remains. Investors demand compensation for future price pressure. Fiscal supply is relentless. With over $7.6 trillion in treasuries maturing this year, the government must sell bonds into a market already saturated. And investors doubt the Fed's resolve. A risk management cut is not a victory. It's an admission of vulnerability. The bond market spoke, and it said, the future is riskier than the present. For 2 months, US payroll data arrived weak, then revised weaker. Investors muttered, coincidence or choreography? In truth, revisions are common. Seasonal adjustments, survey lags, benchmark changes, all statistical mechanics. But when the economy slows, every correction feels sinister. Markets thrive on trust. If trust in data falters, every Fed decision looks political, every report looks staged, and in that vacuum, conspiracy whispers louder than fact. Is the system rigged? Probably not. Is the system fragile? Absolutely. And fragility alone can move markets. The Fed's cut didn't stop at US shores. It rippled outward, forcing choices in other capitals. Hong Kong matched the move instantly, cutting its base rate in lockstep with the Fed, bound by the dollar peg. Gulf states followed too, dragging their rates down to preserve currency stability. But Europe hesitated. Inflation in the Eurozone still burns, and the ECB fears losing credibility if it cuts too soon. Japan faces its own trap: government debt above 250% of GDP, a demographic time bomb, and a yen that weakens whenever US yields climb. And then there's China. Deflation creeps across the Middle Kingdom, consumer prices falling, property developers gasping for liquidity, a trillion-yuan stimulus flooding banks, but trickling into ghost projects, not households. Deflation today risks stagnation tomorrow, and stagflation the day after. If the Fed cuts, the dollar weakens, yuan pressure rises, and capital may flee Beijing's grasp. The dragon fights with borrowed fire. Zoom out further. The Fed's cut lands in a world already drowning in debt. Japan, debt at 260% of GDP, sustained only by ultra-low yields and trust in the Bank of Japan's grip. Europe, Italy, France, Spain, all with debts exceeding 100% of GDP, fiscal ceilings stretched, growth anemic. United States itself, $36 trillion in gross federal debt, with interest costs projected to devour 30% of tax revenues by 2035. In such a world, one default is not isolated. Banks in Paris hold bonds from Rome. Tokyo lends to Washington. Frankfurt owes to Beijing. Finance is a circle of mirrors. Shatter one, and the cracks spread everywhere. So is the Fed early or late? And it might be too early, say the hawks. Inflation still lurks above 2%, waiting to reignite. Cut now, and you may lose control. Or it might be too late, say the doves. Labor weakness has been visible for months, and waiting risks recession taking root. Or it is just in time, claim the optimists for a soft landing. A modest cut buys insurance, a signal to markets without surrendering the inflation fight. The truth? No one knows. Monetary policy is a blunt instrument wielded in fog. Every decision is a gamble, and every gamble has consequences. So let's imagine the paths ahead. A soft landing. Inflation drifts lower, jobs cool but stabilize. Growth slows without collapsing. The Fed engineers the dream outcome. Or sticky inflation. Cuts revive demand too quickly. Inflation rises again. Long yields surge. Confidence breaks. In the worst scenario, stagflation. Growth stagnates. Prices stay high. Unemployment rises. The nightmare of the 1970s reborn. As global contagion. A debt crisis in one nation. Perhaps Italy. Perhaps Japan. Perhaps even China. Triggers panic. Financial linkages spread the fire. The Fed's cut becomes a spark in dry timber. Finally, what should we do with this knowledge? Watch inflation data, CPI, PCE, wage growth. These numbers will decide the Fed's next move. Track Treasury auctions. If foreign buyers fade, yields will climb. The bond market is the seismograph of trust. Monitor currencies. A weak dollar helps US exports, but strains allies. A strong dollar crushes emerging markets. Hedge against extremes. Gold, Bitcoin, cash all play roles when trust wavers. Above all, don't mistake calm for safety. The true storm often brews in silence. In conclusion, the Fed has cut rates, relief for some, warning for others. It is not the end of the story. It is the opening of a new chapter. Will this be remembered as the moment the US avoided a hard landing? Or the moment it stepped into a deeper trap? That answer lies not in today's headlines, but in tomorrow's bond yields, tomorrow's jobs reports, tomorrow's cracks in the global debt machine. Thank you for watching FluxFolio Finance. If this gave you clarity in the storm, hit like, share this video with a friend who watches the markets, and don't forget to subscribe for more stories at the edge of money and power. Until next time, stay sharp, stay thoughtful, stay ahead.